Welcome to the Expert Network Team podcast,
where our goal is to inform and educate our listeners on matters related to finance, legal, insurance, accounting, and other interests that are of personal and business nature.
We hope you will find our content useful as well as entertaining. The Expert Network team consists of Carl Frank of A&I Financial, Mike Miller of Miller and Associates CPAs, Jeff Cromendike of Security First Insurance Agency, and I'm Nathan Merrill. I'm an attorney at Goodspeed Merrill.
Together, our independent team combines our expertise to provide you insights and solutions, some straightforward, some profound, for real-life opportunities we see on a daily basis. We hope you enjoy the information contained in today's podcast and find it useful. If you'd like to learn more or desire to meet with any of the Expert Network team members in person, you can contact us at info@expertnetworkteam.com. That's info@expertnetworkteam.com.
And we encourage you to take advantage of a free consultation with any of our team members. Just mention this podcast when you schedule your appointment.
Now on to today's podcast. Welcome back to the Expert Network Team podcast. This is Nathan Merrill. I'm with Goodspeed Merrill Attorneys at Law, and I've got Carl Frank of A&I Financial with me again today. Carl?
Hi, Nate. It's great to be here. Thank you for the opportunity.
So we are picking up this week our discussion of the current market conditions, the inflation, the recession fears, all the things that can bring turmoil into our portfolio, and evaluating alternatives that people will sometimes propose for those. Last week, we started our conversation talking about gold. And so after concluding that conversation, we're now going to move on to something a little more ethereal.
It should be a great conversation. I'm really looking forward to it.
Madagascar is a great place to hang out, too, but that's beside the point. So let me move you off of gold here for a second, because at least with gold, you can handle it. You can put it in your hand. So I'm going to give you something you can't eat, can't smell, can't touch, can't taste, can't even handle, and that's Bitcoin.
I love it.
Or not Bitcoin per se, but crypto.
Crypto. Yeah. I had a gentleman sit down and give me a Bitcoin the other day. It's a great gag gift. You might have seen it. It's a copper coin. Mm-hmm. I think when he bought it, it was probably $1. I think with the price of copper per ounce right now, it was actually a good investment, not just a gag gift. Well, anyway, so it looks like the Bitcoin logo. And there are three big reasons why.
Reminds me of the Galt's Gold, if you remember.
They're kind of cool.
From Atlas Shrugged, how Galt, in Galt's Gulch, they minted their own coins, and it was real gold, and it had the little dollar sign on it.
In the climax at the end of the whole utopia.
Here in Colorado, actually. So.
Yeah, right. And the technology that was envisioned there to make it invisible from, that stuff is not that far from real.
And the atmospheric pressure motor was really cool. But
there you go.
Once
right?
again,
really interesting, right? So we digress.
Back to Bitcoin. Back to your tangible.
Yes, love it.
Tangible, non-tangible.
Yeah, and right there you go. Three big reasons why we're not big fans of Bitcoin or any crypto, and they're kind of simple if you think about it. But it's not popular for me to think outside of this. But that's what I'm paid to do is to help you really doubt what you're being told. And think and make up your own mind for yourself. And the first is that it's just obvious that Bitcoin and crypto are largely being used by the bad guys. Ukraine was trying before this war to be the crypto capital of the world, and that Ukraine, right, the same one being invaded. It's a scary place to be. That crypto's big advantages are tax-free and quick transfer all around the world. Things that money launderers love to do.
Yeah, I was going to say a little bit of the anonymity of it.
The anonymity. It's
untraceable and
the company that you keep. Right. So if you're hanging out with criminals, it's probably a place you don't want to be. Right. So that's the most obvious. It's just where it is now. And everybody says, oh, but that's not where it's going. Right. The future is so much more bright. Well, the second thing is that might be true. And the big companies are already doing that. And so now you're betting on the crypto being run by the DeFi crowd, the rebels, the future seekers, that they're going to overcome their crook neighbors who've stolen hundreds and hundreds and hundreds of millions of dollars. You see the schemes in the crypto world are huge. They're terrifying. Look up crypto scheme and or crypto crooks, and there's the lists of hundreds and hundreds of millions of dollars being stolen from all over the place is terrifying. Like, this is not where you want to be. The big money's moving in, though, and so Visa, MasterCard, Bank of America, all of these big banks are building their own version of crypto. It wasn't long ago that we joked about the company formerly known as Facebook, now called Meta, and Zuckerberg's idea that he'd build a cryptocurrency, he'd build an electronic currency, his own version of money that you can only use on Facebook, and it was laughable. Well, now it's just prescient. Now it's just, big companies will benefit from this, and so
feeds into that cynicism, the rigged market side of the equation.
Well, yeah, doesn't it? Absolutely, it feeds right there.
And now with the Fed talking about a digital currency as well, you have to wonder, does crypto stay insulated from those types of regulatory pressures? Does it?
Oh, sure, Nate, steal my thunder.
Oh, sorry. Go ahead.
No, you're exactly right. That's the third big reason, right? I mean, the second big reason is corporate, right? The big corporations are going in there. Like you're betting on, Star Wars. You're betting on the DeFi crowd to be the rebels who are actually going to blow up the Death Star. But the Death Star is big money, right? And so I'm going to encourage you to bet on the Death Star, right? Good luck, Luke. Okay.
Yeah, I wish I could remember the line. It's just like hitting the whatchamacallits back on to Tatooine, whatever. Just like that.
It's just
Carl.
like that. That's all it takes for Bitcoin.
I still can't wrap my head around crypto. Like, I help clients with structuring for crypto and being tax efficient on it. But I'm still like, okay, so what's an NFT? Like,
well, yeah, there you go. I mean, we're so off the deep end in America and a lot of the world that we're assuming things like crypto and NFT are normal, but they're crazy. They're a scheme that has no
so is the U.S. dollar
presence.
in my mind, but that gets to me being the same.
Well, yeah, we can talk about that in a minute because that's the big thing, right? So that's the next one. It's the dollar, and the reason, and here's the reason why I have more faith in the dollar, and that's because their guns are always bigger than ours.
Right.
They're always going to require. The government is always going to require, the federal government is always going to require that taxes are paid in their own currency. So in their unit of currency, whatever that is, it's the dollar now. If they suddenly flip, and it'll take a long time before they do this, but they might, and that's why they're exploring the crypto, right? If they create their own electronic currency, they're going to require us to pay taxes in that currency, and we're going to do it. We're not going to not pay taxes.
Well, and it also feeds the conspiracy theories and everything else. Which we don't need to get into.
Well, I love
the ESG stuff.
I love talking about that, but from a retirement planning standpoint, it's just not as effective to make you successful to track whether the government really cares whether you're spending $6 at Walmart or Target. Right. But yes, all of that does happen.
It's like I've said with Alexa in our house. If Amazon's listening in, they're bored out of their mind because
seriously. Yeah.
We're just not that interesting outside of the occasional libertarian rant.
Right. Yes.
So let me move you along the spectrum then. Say, Carl, you've convinced me I don't want to try to eat my gold. I certainly can't touch my crypto, so I'm not going to get more comfortable sleeping with crypto perhaps. You've convinced me of that.
I don't think so.
So I got a great idea. What about something I can touch, something I can use, something I can see, something like real estate?
I love talking about real estate. I knew you were going there, and you and I didn't even talk in advance. And one of the things we talked about in a previous podcast was real estate, and we did a really good job, I thought.
Does it solve my problems, though?
But the 1031 exchange and ways to save taxes and, defer until you die and the income that you can get and how you and I and our friends have recently purchased commercial real estate together and gone into business. And perhaps maybe we're going to benefit from this inflationary trend as real estate has in the past. The tangible assets are just a lot more expensive now.
Assuming office space doesn't go out of vogue, but yes.
And it certainly might,
right?
And I'm certainly going to pay through the nose because you guys beat me to it to build your space out before we had this crazy inflation this year. So it might take me a little bit longer to recoup my costs than it does you, but that's beside the point. I think that real estate can be a great complement, and when I boil it down and take two steps back and think about what you're talking about here, you're talking about equity. You're talking about a concentrated equity position because you're an owner. You're not a loaner. You're not buying a bond and then lending money. You're not being a bank and trying to send your money out to somebody and hope that they're going to give you a little bit of interest and your principal back at some future date. You actually own this thing. you're invested in it. The problem with real estate can be the work, obviously. I mean, we've seen that, you and I and our friends.
The toilets.
Oh,
Even in commercial buildings, folks, toilets can be a problem. Just letting you know. You got a really sorry, I'm going to take you got a hawk out here.
Isn't it
out
beautiful?
Your window. Have you seen it?
I have.
All right.
Isn't that beautiful?
Folks, you got to come by Frank's office and see the hawk. It's
awesome.
It's like a red hawk.
It's a beautiful bird.
Okay.
To me, that's my wife's avatar. That's her that's her spirit animal, I think.
Sweet.
It's like, we just love it. Other people are
dinner
freaked out
time
about
for
it.
the hawk.
Other people freak out. Yeah, he's hungry.
So
he's
yeah,
hunting me.
going back to real estate, even commercial, direct ownership, as it were, has its challenges.
Yeah, and wonderful rewards, I think. I mean, I hope so. I mean, we took the risk, you and I together and our colleagues.
But it's a long-term play. It's not.
It has to be.
Right.
It has to be. I think that the fix and flip, that's a business. That's not an investment. That's a business. And so that's no more, no less of a job than any other job. In fact, in many ways, it might be more of a job to attempt to try and do anything on a short-term basis. I think real estate's a long-term equity hold, and that just makes sense to be an equity owner, not a loaner.
As an investment. Well, as an investment.
As an
like you said,
investment.
right, because the bigger pockets crowd, if you're familiar with bigger pockets, it's that whole thing about the strategies on acquisition, disposition, fix, what is it, buy, renovate, refinance, rent, or something like that, the BRRRR strategy.
Yes.
All these things, and for folks who are interested in getting into the quote-unquote trader business of real estate, that's a different podcast. A lot of great resources out there. But we're talking about real estate as an investment part of your portfolio.
Exactly. And I think that there's something to be said for what you just said. And maybe we need to get one of those folks on the podcast. They certainly have simplified some of the complexities. And it might be interesting for our listeners to do that. I think the business owners who you and I work with who own their own buildings have a little bit more of a flexibility when they get to retirement. When they get to selling their business, the real estate can be a great tool for them.
Mm-hmm.
Add some tax advantages that maybe they didn't have before, income that maybe they didn't have before. Could make it easier for the buyer. Could be, there's all sorts of wonderful things about real estate that can be a complement and a diversifier. But it is a concentrated equity, and so I encourage people to remember that and just be humble about it. That if you're a buyer in Boulder in 1980, you took some risks, right, to get this incredible return you've had over those 40 years. Back then, it was pretty risky. In Denver, when the oil crash happened in the late 80s.
Which oil crash? Just kidding.
Exactly, right? You took some risks.
Right.
Yeah, you took some risks. And some great friends of ours bought in the really seedy part of town. And then, it turned into, Blake Street.
Right.
And oh my gosh, right? The value went up many.
Right.
And it's like an equity. It's a 10-bagger or more.
So I worked with a client back in the 2000s era that had an interesting concept. They were a real estate investment fund. I think you're familiar with these folks. I won't name them on the podcast. But they created an offering that was not leveraged when everybody else was leveraging. And then the 2007 hit, and they looked like geniuses. But that's one of the maybe you can speak a little bit about that, because real estate is one thing as an asset class, but because of its price point, because of what's happening in the market, it is out of reach for some people, and therefore there's the inducement to get leveraged. So talk about that.
I'm so glad you brought up leverage. Thank you for doing that. And how could we talk about real estate and not talk about leverage? And especially this year, we're almost twice the interest rate that it was about this time last year. All-time lows, lower than 3, 2.5 for a mortgage, 30-year mortgage, somewhere in that range. And now it's approaching 5, and for some lenders and some borrowers, more than 5. Wow, holy cow. That basically cuts in half the size of real estate that you can buy. Up 1% from 3% to 4% something now cuts it by a third. So, yeah, it's crazy. And all of us who are homeowners and real estate owners already have benefited from these low interest rates for a long time now. We are going to see, very likely, with any predictability, at the least, some sort of plateauing, right? Unless interest rates subside.
I'm watching prices in Grand Junction right now for undisclosed reasons, but
yeah, I mean that's a.
I'm already
deal.
seeing price drops of $50,000 on $1 million houses, that sort of thing. So you're already seeing a little bit of the cooling. I don't know that it'll be interesting to see if it really does impact, like you say, plateauing maybe somewhat. Might not see years of 20% growth, but at least it will slow the market. And that's almost as important as pulling back on the prices, is that the demand normalizes a little bit with the supply.
Looking at the real estate indices over the past year or two, it's almost a doubling.
Yeah, it's crazy.
Just across the country, like not just in Colorado, but in the past 24 months, you can't have that type of appreciation continue at that rate. And so, yeah, absolutely, things have to slow.
Even in some of the insulated areas, because Colorado's kind of an anomaly. We're a desired location.
I think we are.
Look at a place where nobody wants to go, and hopefully I don't offend anyone here, but I went to law school in St. Louis, Missouri, and we owned a home in Chesterfield, which is out in the county, as they say, and cute little, built in 1968, 1,600 square foot. We bought it for like $149. This was back in 2001-ish. And up until 2 years ago, I think it had gone up to like $220. So $60,000 of appreciation over almost a 20-year period.
Yeah, very slow.
In the last 2 years, it's gone from 220 to 280. So the same amount of growth almost for 20 years occurred in the last two.
That's a great stat.
So, and that's just anecdotal, but I never thought I would have seen that for Chesterfield, because Chesterfield is like one of those areas, it's the Midwest, right? The Midwest is where prices always are the same.
Exactly, I know.
So it's kind of a bellwether in my mind that, oh my gosh, this is really starting to hit those nodes of our globe that are usually insulated from inflation.
Yeah, that's very true. And I think that the big part of that is that, and we worry about it in a social sense, like, can the young people start their families and buy a home, and these are really important. But from the investing standpoint and where do we go next standpoint, it's probably not what just did really well and depended largely upon leverage, which depends on interest rates, which are trending up, and they're going up at a faster rate. If this is annualized, it'll be the fastest rate in history. It's the fastest rate already, in 30 or 40 years.
Right.
I think it's at 79 or 80.
It was artificially low for...
Well, it was low.
Weren't we talking, was it you and I that were talking, or somewhere else I heard, like, that the Fed may have missed this, and when most people think about that in terms of when they should have started raising rates, we're like, well, 1 year ago, 2 years ago, and someone I was listening to said, no, like 10 years ago.
Yeah, they missed it in 2012. Yeah, I think you and I were joking about that on our inflation podcast. So leverage is a big deal, because if you're going to take it on, right, and you got your fixed debt already, you may never see that low rate again. So good job. Keep that fixed debt. Keep that really low rate that you already got at the historic lows. And the rates that you can get today may be lower than what you can get in the future, right?
That's what happened back in the 70s. And again, we've been through that. This may not be just like the 70s, but in 73, you could get a 30-year mortgage for 4%. In 1980, Amazing. It was 18%.
Yeah, how'd that happen, right? And that could
and somehow we survived. So that's the other,
we sure
again,
we
thing
sure
to
did.
keep in mind.
Yeah, and during that period of time, there were all sorts of investments to invest in, and there are all sorts of ways.
CDs
to make this
returned
happen.
14%.
Yeah, if you bought it, right,
right,
and it wasn't callable, some of those are investments that you will wish that you had today. Yeah. Right. So leverage is a big deal, and paying for that. Recently in the equity markets here in the U.S., a lot of recent volatility was due to consumer credit and people being worried about that, and worried about consumers having floating rate, and which means that their rates go up when rates go up, and their payments go up, and then they're going to default. And so we got to be careful about taking on leverage. That in an inflationary time, you really need to be reinvesting and not just spending the money that you're getting in. And if you're not, then you need to get rid of the debt.
Got it. Well, and that was going to be one of my points for you to discuss, was the leverage in and of itself isn't bad. Well, generally speaking, in financial terms, leverage isn't bad. It's the inability to absorb the price fluctuations that are associated with your leverage, right? So if you buy an asset worth 100 and you've leveraged it 80%, and it's never going to go to zero, presumably, at least real estate assets, but it doesn't matter if it goes to zero. If it goes to 60 and you can't cover the debt obligations, it's as good as going to zero for you, because you're now negative in your equity. property's still worth something, but your equity's gone.
That'd be bad. Here's a really cool thought, though. All right, so let's do this. So let's say this is not an investment recommendation, but let's just play professor. All right, and let's make one assumption. The first one is that we think inflation is going to continue. I don't know. Maybe we do, maybe we don't. I think a lot of people today are worried about it, though, right? Okay, and then if inflation continues, we are worried about leverage. And so we're inclined to pay it off. But we're going to take the devil's advocate here, and we're going to say, actually, that's not true.
Right.
You want to have the maximum amount of leverage now at the beginning.
Pay it back with inflated dollars,
and
right?
pay it back with inflated dollars because the future dollars are worth less. So in theory, right, if you are worried about inflation, you're not worried about debt. You're worried about the debt payment.
Right.
You're worried.
And well, that's what people, we talk about people not being able to afford a house. What they look at, the house price is almost irrelevant. What they're buying is a mortgage payment. And so it's all about making sure they can cover the debt payment. I guess where they would become insecure on that is the other flip side of that inflation coin is the recession coin.
Yeah.
Because that's where you have job insecurity and financial insecurity is if you don't have proper alternatives to covering investment debt, then you find yourself in a pickle.
Yeah, you're exactly right. Recession from the personal standpoint, it's going to be different for every person, right? But from the big macro country as a whole, obviously recession is very painful. But you and I talked all through the recession of the past few years on these podcasts and said, here's the things that our clients are doing and we're doing to pull up our bootstraps and make it through these tough times. The last recession we had lasted like an hour and a half. And it was the COVID-caused recession.
The only thing with recessions is sometimes you don't know it until it's over. They can be that short. They're two quarters of negative GDP growth.
And it's outside of our control.
Right.
I mean, I think that when we have hard times, we focus on what we can control. It's just what we naturally do. And no country's better. No group of people in the world has ever been better at, working hard than Americans. So,
and I don't count the COVID one because that's, if you recall the movie Flatliners, do you remember that with Kiefer Sutherland and
that's going back.
Julia Roberts?
Was Julia Roberts in there?
She was. I think she was in there, and where they were doctors and they would kill themselves.
Yeah, it's so weird.
And then they'd shock themselves back into life.
Such a crazy
That's
thing.
what we did in 2020.
It kind of is like that.
We killed ourselves and then we shocked ourselves back to life. So is it really a recession? Did you really die, or was it some sort of game for somebody?
Man,
I won't get into that, but
that's a crazy movie to go back and think about.
Yeah, probably. Yeah. Now all these people are going to be searching on their Prime Video. Where's Flatliners?
Right. Hopefully they can get it for free. They don't have to pay for it.
Just wait long enough; it'll eventually come up on your watch list.
Seriously. Recession is always a possibility, and it's difficult. I think it's really easy to get confused that the world can be really chaotic and scary like it is right now, and the economy can be doing really good like it is. And that's really hard to equate, and it's really hard to put into paper that it's hard for employers like us to hire right now because the employment rate is so low that the people we're talking to are getting offers before they're even off the phone with us, before they even start. Between the time they commit and the time they start, they may have had other offers, and they'll be using us to negotiate better.
And that goes back to our discussion on culture and providing something beyond just a salary in terms of an employer.
Exactly. And in times like this, right, that's when it's most important to do that, and stability and everything else. And so it's hard to equate, but the recession, if you only knew the economic stats and you looked at just that benchmark and you looked at the things that are going on, you'd say, ooh, maybe in the future, right, that this could be a real challenge. But as of now, profits are good. Unemployment is low.
Well, before I put one final question to you, I'm going to tease possibly something else we can discuss as a podcast, and that is this. Recession, and maybe our need to rethink what the next recession might mean to us. Because as I do the math, and I'm a very data-intensive person, global demographics generally are shrinking. People are having less children now per head than we've had in the past. So could recession be a natural demographic consequence, not something bad, but just a natural consequence of the population shrinking. There are less people to produce the same or more. If we expect the economy to constantly grow, that would assume inherently in that mindset that less people are going to have to produce more goods and services in order for there not to be a recession. And so therefore, you might have a technical recession that is full of abundance and activity and low unemployment simply because the demographics behind it. There's no absolute to constant economic growth. Without the people to support, and the technology perhaps is where we get our leverage. Future conversation, because I want to present you one last thought, which is there an alternative that I haven't mentioned that solves my not sleeping and cynicism, skepticism?
Yeah, great ideas, all of them, every single one you mentioned. And I think that one of the things that we believe here is having a full array. And so I am not an expert at everything, and we have experts on our team on things like life insurance and annuities and fixed investments that may be more appealing than they were not very long ago when their fixed rates were very much lower than they are today, and they may be even higher in the near future. And so, yes, there are other places to go than just equities. The number one thing, the three takeaways I would take away are you start with your plan. 2, the investments pay homage to the plan. And 3, the plan requires a planner. So you want to talk to somebody. You want to find a person that you trust and that you can have these conversations with, who knows you and your values and your goals and your relationships and what this money is supposed to do for you, and find all these alternatives and ways to get there that are right for you and your unique situation. Don't just think that you can Google your way out of insomnia.
Right. Well, your insight is invaluable or valuable or what? I don't know if I
appreciate it.
I'm operating on some low sleep here. My RAM is a little full, but really
caffeine.
Appreciate your insight and the conversation. And this might be one we have to also split into.
I love it. Thanks, Nate.
Part 1 and Part 2. But I do look forward to going down this rabbit hole with you on what the real meaning of the next recession is going to be.
Nate, thank you so much. Really appreciate it. It was a great opportunity to chat. Have a beautiful day. Thank you for joining us today. Hope you enjoyed the information we shared.
If you enjoyed this podcast, please feel free to share it with someone else. And join us next time.
If you want to meet with a member of the team, please contact us at info@expertnetworkteam.com. That's info@expertnetworkteam.com.
If you have special topics you'd like to hear about, please reach out to us and let us know at the same email address. Again, that's info@expertnetworkteam.com. Thank you for joining us and have a great day. Thank you for listening to this podcast. We want to remind you that listening to this podcast does not establish a client-professional relationship with any of the firms represented, nor does it constitute legal, investment, or accounting advice, and the views are those of the professionals only.
Investment advisory services may be provided through A&I Financial Services, and securities may be provided through Genios Wealth Management.